No one comes into the market with a fully developed theory on how the markets work and how to approach the markets. So everybody starts somewhere in the market, and so typically the way you approach the market also depends on the heuristic biases that are inherent to you. You know, for instance, when I read Graham's book in 1988, 87, 88, I was very heavily influenced by the logic of value investing and the fact that, you know, it did make total sense about why if you bought stocks below what they were worth and held them for till they were worth selling at a price higher than what they were worth, you would make money. But the idea that not all stocks would grow in value over a period of time was not available. So depending on where you start, you might start with momentum, you might start with value. You will miss other pieces of the puzzle. So typically, when you first come into the market, my experience is that when you first come into the market, many people come in when it's a bull market, and whatever approach they bring to the market works for them. They make money. You know, but because they are new to being in the market, they have not actually developed very clear strategies of trading and investing. So they do what most people do, which is they take their profits quickly, you know, and they let their losses ride. But if you're in a bull market, there are not many losses. Almost anything that you buy goes up. So you end up making money. So at the end of the first bull market, you tend to overestimate your own, you know, ability to tackle the market. You have a highly inflated sense of how smart you are, and in classic term, it's called confusing brains with the bull market. The bull market gives you money, and you think you're very smart. But because of the natural tendency of people to book profits early, you end up making some money. And so when the next bull market comes, you look back on your experience and say, "Oh, I bought this at 100 rupees, and it went up to 200 rupees, and I sold it. But eventually, it went up to 400 rupees. I should have just held it. So you make some corrections to your approach. This is one kind of correction you could make. That So next time you say, "I'm not going to sell it so fast. I'm going to hold it." So you buy at 100 because the bull market it goes up, and almost anything goes up. Even if you not like have a very great ability to pick stocks, most stocks do well in a bull market, but you don't sell because of your last experience that you sold and the price went up more after that, and then you keep holding, and the price comes down, and you say conviction is very important for you. You keep holding, and the stock comes back to where you bought it, or even below where you bought it. Then you realize that stocks can go up and come down, and the poor quality stocks that you have bought in your portfolio actually do very very badly. They actually go down well below your purchase price. You end up not only, unlike in the first bull market where you didn't know much but you still made some money, here you actually lose money, because the poor quality companies will decline in stock. So at the end of the second bull market, you actually have lost money, eroded your capital, but you have learned something. Now you realize that there are good stocks and there are bad stocks, and good stocks you should continue to hold them, and bad stocks you should get out when they start coming down or when they go up too much. You realize that apart from buying stocks, you need to have a strategy of when to book profits and how to book profits. So when the third bull market comes, you approach the bull market with some knowledge about what to do. So you trade your stocks better. You're more careful about picking better quality stocks. You're more careful about keeping your stop losses maybe, and maybe letting your profits ride, but cutting them when the market turns against your favor. So in third bull market, you actually make some money. You know, but this is the first bull market in which you made some money and you also learned something. You know something to do. So you need the fourth bull market to come when you approach the bull market with what I would say a good strategy and with some capital. So most people make money in the fourth bull market. Of course, some people have mentors. There are people that they work with. They can learn from the other person's experience rather than going through the experience themselves, and those people can do it faster. So either you go through these four cycles or you find somebody with whom you can work.